Good afternoon, everyone, and welcome to your December market update. I'm Dylan Silbernagel. That's my partner, Matthew Gizzie. We are here today to talk all things housing in the GTA. Matt, how are you doing today?
I'm good, buddy. Weather's crummy outside. I'm thinking about everyone up in Simcoe there. I heard it's really coming down up there. So we had a little bit of snowfall here up in Sharon, but not too bad. What have you seen in Aurora today so
Yeah,
far?
it was still snowing last time I looked out the window, and we are planning to head up to the cottage this evening. So the
Oof.
question lies, do we take Highway 11 for the shorter route, or do we jump over to 35 and avoid a lot of that highway, snow
Yeah.
squalls, all of that? And I think that's going to be the plan. 35 seems to avoid it just a little better. I don't
Oh,
know.
good luck with that drive.
We'll see. All right, buddy. So, as usual, everyone, we have compiled all the stats going through York Region, taking a look at Freehold, taking a look out in Durham, taking a look up at Simcoe. We are also taking a look at some policy changes that are directly impacting our market. And we're just really going to start out with a snapshot of year to date, what's been happening in the GTA housing market, and with a little bit of outlook there as well, because I think a lot of people are wondering, like, what does this mean going forward? What does this mean for my sellers? What does it mean for my buyers? What does it mean for my business if I'm a realtor? So we're going to break down a lot of that stuff because our goal is to arm you with the information you guys need to make the right decisions. If you're a realtor, we want to make sure you're getting the information so you can better serve your clients. So let me just fix this screen I moved over here, and then we'll jump right into it. So first, let's take a snapshot at what happened in November. We're taking a look here at sales and average price. And Matt, I want to jump right down to the year over year because the numbers up top when we're looking at a monthly basis, it makes more sense to you, I think, when we look month over month so you can see a direct comparison. We're going to get into that when we get into our specific municipalities. Let's just look at the overall totals. And I think looking year over year makes the most amount of sense. So when we look at the detached housing market, year over year, we're down 14.8% in terms of sales volume. And really, the 905 took the bigger brunt of a hit there, down 16%. Semis, not as big of a hit, but again, the 905 really taking a hit there. And funny enough, the 416 showing a positive boost there year over year at 1.5%. So happy to see that. And then moving into the condo market, I mean, the down 21.7%, I think, is pretty stark because we were already starting to feel that struggle last year. And I know we're going to get into this, but when we pop over to the average price, condo market didn't take as big of a hit as you would have expected when we're looking at some of the other numbers.
Yeah, one of the big giveaways just on this chart alone is that sales were down 21.8%. So we're dealing with a lower amount of sales to be averaged or medianed out there. So that does have an effect on what potential price you might see. But there was definitely a difference between the 416 market and the 905 market. 905 market saw we were down 8.7%, but in the 416 it was 1.7%, which was the best. It held up better than the detached, semi, and towns. But I think we do have a chart on why that might be.
Yeah, exactly. And acknowledging that they've already taken the big brunt of their hits so far. And it's I think what's important to take a look at this is the initial outlook in 2025 was that we'd kind of really hit the bottom, that we were kind of in that trough. Maybe we'd even see some recovery this year. Like the TREB forecast at the beginning of this year was showing positive gains, a little bit in price, more so in sales volume. Now, obviously, sales volume has dramatically come off of that, and we felt that. But the prices have continued to slide a little bit more than I think was expected come the start of the year. Now, obviously, we had a change in government down south. We've had this tariff trade war going on. And so what's important to just note is here's the actual impact we've seen because of those changes. And again, when you're looking at detached year over year, people that bought this time last year, they're down 8.8% on that purchase. When looking at the semis, down 7%. And again, the bigger hits really coming in the 905. I will say I was a little surprised to see detached 416 average price down lower than the 905s. And the important thing that Matt and I really want to bring to your attention over the next couple slides, and with this chart in general, is TREB is using average price here for this particular chart that we're showing. Median price is more reflective of what we're actually feeling in the market. When you go to the composite benchmarks and all that, even better. But for now, just know that there's bigger swings here. And as Matt was talking with the condo, it's a little bit more of that luxury side where we're seeing the change. And so we'll get into that. But Nat, actually, why don't you start right in there? Why don't you talk to us a little bit about why we're seeing that softer slide there in terms of pricing for the condos than what we might really have felt?
Yeah, so if we look at the top chart here, the blue dotted line is your average price, and the red bar line is the spread between your average price and your median price. So the chart below it, you can see the median price in the orange, the average price in the blue. So what we're seeing is a disconnect between, a significant disconnect between your average price and your median price. And what this kind of means is that the luxury end, the high end of the market is doing more of the heavy lifting when it comes to the average price point. We can see that the real market has kind of stagnated down below there, but for whatever reason, we saw quite the uptick in luxury condos, or at least some of the bigger condos, your 3 bedrooms, family size condos that were doing most of the price gains in November.
Yeah, and so you can see as we trended through 2020, median average price stuck pretty well in line with each other, and it's really just been in 2025 that we've seen that divergence that Matt's talking about, where you've seen a bigger spread. And when you take a look up here, we're over an $80,000 difference between the median and the average price. So it's important to note that, and then ask ourselves, why is that happening, right? How is the average getting so skewed in comparison to what the bulk of homes are selling? And the real reason for that is those luxury homes, or those higher price condos, are doing quite well. Well, I don't want to say quite well, but in comparison, we're seeing more of those sales as sales volume has dropped off. Who's buying the condos now? We're seeing more family style condos as opposed to investor condos selling. The investors have essentially left the condo market right now, and we're not seeing that stuff move unless it's at a pretty discounted price.
The one good thing about this chart, though, is it does appear that the median price has stabilized throughout the year. It's gone quite sideways here, so it is possible that we are starting to see at least a floor develop when it comes to the condo side, at least in the 416 in Toronto.
Yeah, well said. Okay, now let's take a zoom out look here at 2025. Like we said at the beginning of the year, Treb's outlook was we were going to see a rebound there in our sales volume. We're currently sitting at 58,775 units sold for the year. Now, when we wrapped up in 2024, we were at 70,275. So we expected to be over that coming in this year. And obviously, that is just not the case that we're at. And it's not going to be where we end up. If we take a look at December last year, we did about 4,000 ends. I don't think we're going to hit that again if we're trending. The only thing that will keep us tighter that number is that it's already a low volume, and there's just people that buy and sell because of life anyway, kind of regardless of what's happening in the market. So maybe we hit 3,500 or 3,000 more transactions, puts us at that, I don't know, 61,000, let's say, somewhere around there. And really, we haven't seen, going back to 2011, we haven't seen sales volume that low in a lot, like really on that chart at all. The only time we're even in the 60s again is 2023, after the 2022 correction. 2022, even with the change in pricing that we saw and the interest rates going up, we finished with 75,000 units being sold. We finished the following year at 65,000. We went up in 2024. Hey, looks like we should be doing well. We've added an extra 5,000 units back into the market. And now we're looking at quite the difference. So we're almost going to be 10,000 units off of last year. Call it 8,000 if we're being generous. So that sales volume really has to return to get this market kind of stabilizing again. And we're just not quite there yet. We're looking at so far year to date average price being $1,071,000 in comparison to last year's $1,120,000, 2023 at $1,126,000, and of course 2022 at our peak $1,190,000. So Matt, I mean, let me go back at the start of the year. We kind of started to see some negative news pretty early on. Not our first video. I mean, actually, yeah, the Trump effect. And we actually, the very first week before anything really happened with Trump and the elections, Our biggest concern was the amount of inventory we were coming in with. We were, I think if I remember correctly, 50% more active listings at January 2025 in comparison to January 2024. And the writing was on the wall there. There are so many more homes available for sale. There's going to be some downward pressure on pricing. But I don't think we at the time anticipated sales volume being as low as it is.
No, but at the end of the day, Donald Trump came in. He decided that he was going to slap the world with tariffs, and really that affected consumer confidence at the end of the day. And the consumer confidence really hasn't recovered since that. I think a lot of people are sitting on the sidelines waiting for, people voted the Liberal government in to get a deal with the United States of America, and that just hasn't transpired just yet. The deal is up next year, and Donald Trump, I think he even came out today and said, "Hey, we might just let it roll off and forget about it." Or we might negotiate with him. He's going to play hardball, and unfortunately, I don't know if it's going to resolve itself anytime soon. So I think ultimately that is one of the big issues in our market right now, is that consumer confidence. And Canadians, it seems every day, are going to the news and they're seeing that there's layoffs happening in the market, which is a direct result from the relationship with the United States. So I think that had a really big effect on the housing market, among other things as well. But I think that was really a big one.
Yeah. Yeah, no doubt. So let's keep taking a little look here as we talk about the state of Canada right now. And one of our concerns is the amount of growing debt. And the reason why we're just talking about this is we need to talk about, hey, are our Canadians able to go out and buy and sell houses and make the moves that they want to make for their family? And I think the growing debt and obviously the interest rates are some of the biggest concerns that we have that we're looking at beyond consumer confidence, because really that I mean the debt that you're sitting in won't make people feel great about making those decisions. But when we take a look at getting our sales volume back into it, I think the biggest impact here has been the uncertainty. Has been people wondering, what does this all mean still? Maybe it's not the right time for me. As well, is this slide in pricing going to continue to happen? I will say that coming out of January at our 1,041, we're hovering right back kind of where we were. We're at a 1,039 in terms of average price in comparison to where we started the year. So that part's is what it is. But when we look at what we've wiped out from the start, like from looking at May, I think this is where people have some of that concern. If I buy it today, I don't want it to be worth less tomorrow, right? And so that coupled in with our Canadian debt conversation, we're just trying to get a sense of where the public is in terms of making these decisions. So Matt, why don't you talk to me a little bit more about the debt, and specifically, well, I'm just going to throw it to you because I want you to be able to explain this clearly. And who are we talking to when we're sharing this information?
Well, so the reason I've highlighted this chart is, Canada has one of the highest debt to income ratios in the G7. Now, that's not a big deal as long as you can get rates down to a level where people can either refinance their debts and afford their monthly payments. But ultimately, what's going on right now is one of the biggest worries that I've had for some time is something outside of our country going to happen that will affect our country's and our people's ability to refinance their debts and to be able to work with that. And the problem is, in Japan, we're starting to see their 10-year government bond yield rise quite significantly. And there's a thing called the carry trade, which a lot of countries around the world, a lot of investors around the world use. So you can see on the side here how the carry trade works. So borrow money in a country with a very low interest rate. So Japan had a significantly low interest rate from 2016 all the way up into the early 2020s. And then what countries would do is convert that money into another currency. So now you can convert it into USD, you can convert it into Canadian, and you can start buying those government bonds with that money. What's happened now is that the borrowing rate in Japan is not cheap anymore. It's expensive, which means less and less people are borrowing that money from Japan and buying Canadian and US government bonds. which ultimately means if you have less buyers for the bonds, the yield has to go up on those. And that's what we're seeing right now. We're seeing the 5 year, the 10 year, the 20 year in Canada. We're seeing those yields start to go. And we look at the next chart here, we can see that the blue line is the central bank interest rate, your variable rate interest rate. It's come down quite significantly, but the 5 year fixed rate, which is tied to the bond market, is going sideways. And this has a lot to do with the fact that the carry trade in Japan at the moment is off the table. So you've got less countries, individuals out there buying those bonds. And that's a huge headwind, because a lot of people in Canada don't trust the variable rate. They don't want to lock into something where their payment could significantly go fluctuate. They want something a little more certain, which is why 5 year is for the most part a little more favorable. And if that's the case, then we're potentially, if we go to the next chart, we can see that the long end of the yield curve is going higher. So the blue line is where bonds were last year. This is so your 1 year all the way up to your 30 years. This is what the prices that were being paid. And the black line is this year. And we can see that the black line on the long end of the curve has gone above the blue line, which is telling me that the market expects that government spending is potentially going to be inflationary, and that the carry trade in Japan is going to potentially keep rates higher for longer. And we might be in a situation right now where the fixed rates are at their lowest that they're going to be, unless something breaks in the economy, unless something breaks in the world where interest rates are cut drastically. The bond market goes out and says inflation's done. We're worried about deflation, which is far more scarier than inflation. Then we could see that. But as of today, with the data that we have, the markets are telling us that the fixed rates are likely done. And that's a scary thing when you look at the initial chart about the amount of debt that's in this country, the amount of debt that's owned by people, the amount of debt that's owned by corporations, the amount of debt that's owned by governments. They need interest rates to come down to, like in this chart that we have up right now, we can see from 2009 all the way to 2022, we had significantly low rates. Also, borrowers on a 5 year period were able to refinance their debts at a lower rate. Households refinance their debts at a lower rate, and the price of the property was significantly more expensive. And we're at a time now where people are refinancing into a higher rate, and potentially anyone that bought in 2001 is refinancing potentially at a lower valuation than what they purchased in 2021.
Okay, so what I'm hearing in, because I'm looking at these charts and there are a lot for me to look at as well. I think what I'm really hearing you say is because of some outside factors, outside of our country even, we're seeing the bond market say we can't drop these lower right now. That's just going to be a challenge for us. So we're seeing the
You
variable
have to
rates, the
have a
Bank of
buyer for
Canada.
that debt. You have to have
Yeah,
a buyer
exactly.
for the debt. So the central bank could come in and buy up all the debt and drive the fixed rates down. They
I
could
don't
do
want to. I
that.
don't want to
Right?
go. I don't want to go deeper on that
Yeah.
for a second.
Yeah.
What I just want to make sure everybody's taking away from what Matt is sharing here is that our challenge is going forward. We don't think those fixed rates are going to come down too much. We're at least right now. What Matt's saying, he's seen indicators that that bond market doesn't want to move too much. It's gone sideways. Meanwhile, we've seen the Bank of Canada keep cutting. They're worried about that added spending from the government then being an inflationary problem. But our homeowners like the fixed rate mortgages. They like the security. I like knowing what my payment's going to be. But we're in a time where now people that are renewing, are refinancing, are going to be doing so at those higher rates. And for one of the first times in a while, we're doing so, like in the stretch, anyways, we're doing so when we don't have the equity in the home that we used to have. So what Matt's saying is a little bit of a headwind in terms of like a leading indicator for some of the challenges we might see. Do I feel like I got that right there, Matt? Or?
Got it. You hit the nail on the head. And I'll add one other thing is, since the 2008 financial crisis, I've found that more and more people, when they go to renew their mortgage, are actually refinancing the mortgage because they have credit cards or auto loans that are at a higher rate. then what? So it's easy. It's better for them just to put it on their mortgage because they're paying an extremely lower rate to carry that debt. And now they're at a position where, listen, you can't roll that debt into your mortgage right now because you haven't built enough equity up.
Equity
Now,
to
this
do
is
so.
not everybody. This
Yep.
is a small fraction of the market that, well, not a small fraction, because a lot of people refinanced at these extremely low rates during 2020 to 2022. Um, but this is something we have to keep an eye on, and it's something that's going to come to a head in 2026,
Yeah.
because that's when a lot of the prices were at their highest back in 2021. So now they're refinancing at, or if they have to refinance at today's prices, which are a little bit lower. So it's going to be harder for them to roll that $2.6 trillion onto,
Yeah.
if that makes
When
sense.
when we had Nicole Ferrugia, one of our mortgage brokers, on a few months ago, that was one of the things she shared with us. She's seen on average about 70,000 being refinanced, being added on to that mortgage because of other debt. That those headlines with that debt load, this is how that impacts people specifically in the real estate world, is they're adding that on to their mortgages.
And Dylan, if you just go back to that, go back one more.
Yep.
Right here, you can see from 2018 to 2022, interest rates were not too far off from where they were today. Right. So a lot of those people that were rolling those debts in over the last couple of years, they were not as low as what we saw between 2020 and 2022. Those debts were extremely cheap that people were getting, and now we're unfortunately significantly above those levels.
Those levels. Yeah. All right. Let's take a look at what happened so far in terms of the York freehold market. So when we come in here and we're looking now at a month over month basis, we still saw sliding prices, median prices being down 5.4% month over month. This is now going from October to November. That's the slide we're seeing. Transaction volume dropped by 21.5%. New listings came down 30%. So that should hopefully help our months of inventory a little bit. But with transaction volume falling so much, we'll see how that really plays out. Our median days on market hovering around that 8.7%. We went up 2 days from 23 to 25. Not unsurprising with that transaction volume falling down. Termination volume dropping down quite a bit. So that's a good sign that people are kind of finding the price points that they should be sitting at, and they're holding in that moment. Now, when we take a look at year over year, we're seeing that 8.9% decrease now in median price. This is freeholds in York region that we're talking about. And we're seeing that same 21% decrease in transaction volume. Terminations, days on market, a little less relevant in terms of our year over year stat for now. But what I want people to take note of, for those that are in the market, is you still felt that downward pressure on pricing on a month over month basis. So it's so critical, realtors, that you get your pricing right at the beginning, because now your homeowner's home is worth less this month than it was last month. And if you couldn't get them to see the pricing that they needed to sell at that time, they took a deeper hit. So while it is painful sometimes to go with the price that is needed right now to sell, it's more painful if you get it wrong and try a higher price and then sell the following month with that continued downward pressure that we're seeing. Now, as we roll into the chart, what's important here for you guys to see is we're showing, dating back to 2011, the new listing inventory fluctuations on a month over month basis. Looking at new listings, seasonality, we're right where we should be, kind of bang on in the mix with everybody else where we see new listings. Still a little higher than what you'd expect the big bulk of this to be, but not that bad in comparison to peaking out. Now, when we take a look at our active listings, here we are. We're the second highest we've seen for a month of November. The only higher time we saw was in 2017.
Oh, 17, sorry, yes.
Yeah, we're just cusping. We're rubbing against 2018 right now. We're up just by a couple hundred or 100 units there.
2017 is actually invisible because of its color, but we're actually below the 2017 numbers.
Yeah, right there. Yeah, because they did 3,658 new listings in the month of November, where we're coming in now at 3,424. Again, we're talking about York freeholds. And Matt, what's been so interesting about this sales line, because we've talked it, every month this year, how it's just kind of maintained. We never saw a spring push. We never saw a fall push. It's just been maintaining. What I think we're seeing when we look at this is those are the people that are moving because of life, and life doesn't care what's going on with interest rates. Life doesn't care what's going on in the market. You're going to move, right? And so I think that's just in York region, hovering around that 600 units. That's just the people that are going to move kind of no matter what on a monthly basis.
And listen, if you're selling a home to buy another home, you're in a sideways market. You're okay, prices may be down on the house that you're in now, but the price of the property that you're going to buy is down as well. So
Exactly.
for a lot of people, you're making a sideways transaction when you're, as long as you're in somewhat of the same area location, depending on where you might potentially move to, there might be some upside or downside. But just to keep that in mind for people that want to make a move, want to make a change. Just because prices are down doesn't mean that it's not a good time to do it.
Exactly. The move up buy in the down market is a great move to be making because you will net out positive in the end. Now, as we talk about median price here, we have solidly dropped below that 2021 line. We're just above 2020 in comparison to where we were this time in 2020. It was 1,118,000 for the median price. We're currently sitting 80K above that at 1,198 in terms of median price as we look across all home types for freehold in York region. So what's important here, as we talked about with Matt, is when we take a look at the bond market and we take a look at our fixed rates, we're now coming into a time where a refinance might be happening and the equity isn't there. We were actually below what we paid in those years. If you purchased below 2021 or prior to 2021, not going to be the same concern, but anybody 2021 and beyond, this is a concern and a challenge they may be facing. And when we take a look at our months of inventory, climbing steady since 2024, a couple seasonal adjustments, but we're over 5 months worth of inventory currently at 5.38 in terms of the freehold homes that are on the market in York region.
This is an important chart for me. We typically see these big drawdowns, and they're always typically at the end of the year, November, December, January, maybe. We're in November now, and we're working our way upwards, not downwards. So I'm very intrigued to see, for when it comes January 1st, how much the month of inventory dropped over the December period. Because I have a little bit of a suspicion that a lot of people aren't going to take their properties off the market over the holiday period. They're going to keep them up there. And what type of influx of more properties are we going to see January, February, March? I really think that this chart's going to have to go a lot higher into the potentially 6 or 7 months.
Matt, I'm glad you brought that up because I have had this conversation with a few agents as well, and just know from our own team, if it is an owner-occupied home right now, a lot of those people I think are still going to take their homes off the market. At least in my bubble at the moment, agents I've talked to signing a couple cancellations. Will be coming back on in January. I just don't want to be interrupted over the holidays. It's been stressful enough. But if you have a investor property or a home that is currently vacant because they've moved out, they bought something else, whatever that may look like, those guys, this is that time of year where I think it makes more sense to keep it on the market if you can and pick up those guys that might just be doing a little holiday shopping in real estate, because it does happen. They're not as, it's not as big of a volume, but I think that it still makes sense to be doing that, because if you can even subtract a few of those family homes that want to be off the market for the holidays, it gives you a little bit more time to shine and be seen. Even if a buyer doesn't make the purchase right then, it's your chance to be seen through the field of other people. So that's just something that I wanted to share with everybody, because I think that there are agents that are asking themselves that. There are homeowners that are asking themselves that. And if you can stay, just like what you were saying at the beginning, you're going to probably see more people stay on. If you can stay on while some others come off, I think that's more important now than relisting in January when we have a strong suspicion we're going to see that big influx again, because we've seen the inventory the last 2 years stay higher than what we'd seen previously. What do you think about all that?
Listen, I bought a investment property on December 24th, so I can't disagree with what you said
Yeah,
there. That's for sure.
exactly. You know, we've been tracking these charts a long time. You and I've been doing this over 2 years now, and we separately, before we realized that we were both watching the market this way, we had been tracking our own data. And I remember showing clients every time I show them the seasonality of average price. Now, before this market, it was very predictable.
Mhm.
Average price would drop in the months of July and August, and again in December and January. And I look back on when we've purchased our homes, my wife and I, we purchased one in August and we purchased another one in December. And we did very well on both of those buys. But it's funny that just having watched those trends for so long, we innately were looking during that time to make the purchase. And it's amazing to hear you share the same story that with everything that we're watching the data, we ended up buying our homes, our investment properties at the same time because we know that we see those dips.
Yeah, as an investor, you shouldn't be lining up to get into a bidding war in March, April, May. Your opportunities are typically in the summertime and November, December, January to find properties that, typically when you're looking at investment, the seller might be pretty motivated to move on from it,
Yeah.
and you can find some great deals during that time.
There's some I promise you right now, everyone, there are some motivated sellers out there
Yep,
that will probably take a price that you're not thinking they would take right now. A fantastic time to pick something up.
yep.
All right, Matt, I want you to take this away for a second. Talk to me a little bit about what we're seeing in the York condo market.
Yeah, so we actually saw a bit of an increase when it comes to price in November. The median price was up 2.5% month over month, but year over year was down 5.2%. Transaction volume was a big one, down 20.6% month over month and down 27.3% year over year. Again, I think condos have been really, they really saw their price decrease right off the bat. There was clearly so much supply coming onto the market on that side, that we started to really see the downturn earlier. When we look at the new listings volume, down 26.4% month over month, down 9% year over year. Median days on market was actually down 6.1% month over month, but up 10.7% year over year. Termination volume came down 17.2%, which was still up, though, over year at 3.3%.
Beautiful.
We're looking at the new listings volume again, much like the detached or the detached market. We had a couple years that saw a little bit more. Actually, one year that had more, and we're kind of in line with where we were in 2017 and I believe 2020,
Yeah.
when it
Interest,
comes to the new listings volume.
Interesting that we're deviating outside of the pack a little bit more.
Yeah.
It's still a little bit higher in terms of what we would typically see this time of year in comparison to the past 15, which is
Yeah.
interesting.
Active listings, though, we're still significantly high on the active listings on the condo side. So, although it does appear that potentially prices are starting to stagnate, there's still a lot of inventory on this market. And I wonder, I know there's a couple of condo developments that are finishing up in York region, so we do know that there's a little bit more supply heading onto the market. Um, but this will be an interesting one to see, starting next year. Are we going to be even higher than we were in 2025 to start the year for active listings? Hopefully, we are below that coming into the new year. And then looking at price, we can see that we're between 2020 and what's the other one there? 2020 and 2024 pricing.
Yeah. Yeah.
Um,
2024.
Caught in the middle there. I fully suspect that we will be back at some point next year underneath potentially the 2020 pricing, at least to start the year, maybe because it is a little bit elevated to start the year.
Yeah. It's really starting to feel like we're erasing all of the COVID gains, is we're on the track to see that happen, which is that
Yep.
5 year mark. Right.
And then months of inventory. We're at the end of the year here, and we are accelerating to the upside. Hopefully, we do see the rollover for December, potentially January here. Um, but there's a very real possibility that we're going to be in the 8 to maybe even the 9% months of
Months.
inventory mark
Yeah.
if we don't see buyers start to come to the market and scoop up these condos.
Yeah. All right, rolling over to Newmarket and taking a look at the freeholds in particular, we saw a decline month over month of 7.5% in terms of our sale price, our transaction volume being down 17.5%. When we look at the year over year, prices continued to slide there. We're down 10.5% when we're taking a look at that same time last year. Transaction volume down larger, down 33% year over year. Our new listings down 27.8% month over month, so quite a substantial drop there, but still up in terms of the seasonality that we saw last year. Our median days on market going up 2, termination volume, up 1.2%. They're still adjusting there just a little, up 44.8% in comparison to the previous year. So again, we're seeing more sellers have to adjust that pricing to get in line with the buys as we've seen transaction volume dip away. And when we take a look at the chart of new listings, much more accurate than what we saw even in the condos and a little bit more than York overall. We're kind of in the middle there in terms of what we would typically see for new listings. At 130, it's close to what we saw in 2023. It's close to what we saw in 2019. And our peaks were really 2017 there at 282 new listings coming on the market compared to our 130. And Matt, when I think back to 2017, the major adjustment really happening in April, right? And it's funny, in new listing activity, even you could see the drop off as that announcement was made. The Fair Housing Plan was the biggest announcement that came out and just stopped everything. There are other factors, of course, that we've talked about, but that's the one where everything just hit a wall right there. And so I think when we see that high point coming up in 2017, am I looking at? I think I was looking at two different charts there. What's my pink one that would have dropped off?
No, that pink one was
That
the
oh, sorry, that was
pandemic.
yeah, it
And
was pandemic. Thank you. That was
yeah,
2020. This looks a little more fuchsia over here. Anyway, so I do want to go back to that and just see.
you can
Everybody was
see
listing. Everybody was listing.
everyone. It's the worst
Yeah.
one to be the lightest color because it's all the way at the top of the chart there
Yeah.
in the
Yeah.
500s, or
But
no, the 282s.
it's just interesting to see that we saw so many listings coming out. And when we see that level of new listing, Matt, what it speaks to me is termination volume being up high as well, right? With termination volume being up high, we see the cancel and relists as people try to get their pricing right. Now, when we come over and take a look at active listings, third highest we've been for a November month. We're sitting at 253 active listings, well above the normal trends that we would see and coming in below our 2018 and 2017, respectively, as you take a look at the graph there. Sales volume continuing stagnant throughout the whole year, coming in at 52 sales. In comparison to 2021, we were looking at 132 sales there, and 2020 would have been our peak with sales volume at 142. And this is just, to me, this is the people that are going to buy and sell regardless. And we're looking at about 52 of those. Matt, with some of the deep discounts that we're seeing in pricing, I hope that we see this push up a little bit more as people take advantage of some of the purchases that are out there. And that could be move up buys, that could be first time home buyers coming in. The townhome market and the semi market has come down quite considerably in pricing as well, making them much more affordable for those guys. I think our biggest challenge is we are not seeing people flood up from the condo market. There's not enough equity for them to take that next step into the townhome market alone, like to rely solely on equity as people have done for decades past.
Yeah, there's a video that I'm going to do later on, and it's going to show that there's two different individuals in our economy right now. There's the luxury side, and then the average side, and it's very hard for the average to move their way up because they're experiencing the higher interest rates, the more
Mm.
debt. They need a mortgage when buying, and on the higher end side, they don't need mortgages. They're all cash buyers. So if you're on the higher end side, you're looking to maybe downsize. You're maybe even go into a condo, something like that. there's a nice gap there for you to downsize into and still have a bunch of money in your pocket. The problem though is on the median side, it's extremely difficult to go up to the high side because of where rates are right now, where confidence is right now. Am I going to have a job next year right now? That's really what's weighing on a lot of people's minds. Because from the data that I see in the differential between average prices and median prices, the higher end is holding up decently compared to where the average individual is.
Mm-hmm. Well said. Taking a look at our months of inventory, not as high as what we saw in the condo market, but we're creeping up on 5 months worth of inventory there.
Actually, can you go back one?
Yep.
To the median sale price there, like,
Yep.
we've fallen below 2022 pricing now. 20
Yeah.
or 2020
2020
pricing.
pricing. Yeah.
Yeah.
This
I
is the
mean,
first spot so far that we've seen dip below the 2020.
Yeah. I mean, it did accelerate to the upside at the end of the year for 2020. So going into 2026, well, we will be above 2020 pricing, but we'll still be below that 2021 pricing and quite a bit. And again, this was another video that we're going to do, which is kind of showing that going into 2026, there are some issues where at the end of the last 6 months of the year, people that are going to be renewing and refinancing are going to be doing so if they had purchased a property during that time at potentially 20 to 30% negative equity in their property.
And so this is why these videos are important for agents. These are the people that you need to be helping. These are the people that you need to get into conversation with. Partner them up with one of your best mortgage brokers that can help them start planning for this when the time comes, so it doesn't hit them and the stress hits and they're like, I don't know what I'm going to do. Meet early, create a plan, be somebody that's there to provide a solution. And if you're a homeowner, same thing. Reach out to Matthew or myself. Let us put you into contact with somebody like that so you can start planning, because it is the reality of where we're sitting. And the best thing we can do is have the right information and be able to come up with a plan.
Yeah, you cannot wait till the second half of next year to make a decision on this. You need to make a decision yesterday about whether or not you're going to hold the property, or if there's a mortgage agent that can help you out and get you through this, because there will be potential challenges next year if, like I said, the trade deal between the U.S. doesn't resolve itself.
Yeah. And this isn't everybody, to be clear. This isn't everybody, but there are going to be people that have challenges that are now refinancing at a higher rate and don't have the equity there to do so, or don't have the equity to make it easy, or don't even have the room to add on that on average $75,000 that we've heard about from our mortgage professionals, that are people adding on to their debt because of higher debt loads in other places.
Yeah. We're looking at around 4,000 to 6,000 people that purchased in the second half of 2021. If you bought cash, it's not a big deal for you. If you bought with at least a 20% mortgage, and if you look at CMHC data, it says that around 40% of the people have insurance, which means that they paid with less than 20%. Those are the individuals that maybe as an agent, you should be looking in your market as who bought and going door knocking and saying, hey, is everything okay? How, are you potentially thinking of selling? Is there anyone that I can get you in touch with to help you out if there is a problem?
Come with a solution and be ready to help. Let's take a look into Aurora, and we're going to take a look specifically at the freehold market here. Now, funny enough, on a month-over-month basis, we didn't see much of a slide in median price, which is a great sign because Aurora had seen some real ups and downs there. So month-over-month, we're only down 0.8%. Transaction volume, we're still hitting big numbers there, down 28.1% month-over-month. If we compare that to the same time last year, we're down 36.9%. So what does that look like for those that are doing transactions there? Well, last year we had 65 units. This year we did 41 units. So that is still a challenge that we're facing. Median price being down quite substantial here. And now you have to note that even though we're using median price, it's still not as great as the benchmark price, because it's hard to get apples to apples when Aurora has such a wide spread in home values and home types. So our median price down year over year, 15.6% there in Aurora. When we take a look at the increase in median days on a month-over-month basis, this is our largest jump so far, up 64.7%, moving all the way from 17 days on market to 28 days on market when we're taking a look at that on a month-over-month basis. about the same as we were exactly the same as we were last year. So that's interesting to see that seasonality of how long homes are on the market remaining the same year over year. Transaction volume still being down 18.8%. So that's actually a positive sign that we're either seeing people hold out with their pricing, ride it out, not seeing the same cancel and relist. And a little bit of what Matt was talking about as well, seeing more people just staying on the market. And the benefit to staying on the market right now is there will be people that take it off for seasonality. It's your chance to be seen by a potential buyer through that sea of listings that we've been seeing. So not bad to stay on the market in that situation. Termination volume year over year, we're up just a little bit, 9.5%. Then taking a look at days on market, like I said, was the same. Let's roll into the visual element so you guys can see where we sit here in terms of new listings. We're on the high side of the bulk of what we would typically see for this time of year, dating back to 2011. In comparison, some of those years running up to 2015, we were ranging anywhere from 69 to 79 new listings coming on. We're currently at 103, which matched what we saw in 2024. When we take a look at active listings, this is where we're seeing the downward pressure on pricing, is because there are so many homes available. There's a lot of opportunity, a lot of choice there for buyers that are out there looking. We are the third highest we've been. Matt, the only saving grace when I look at these is we aren't setting new highs right now. So hopefully we can continue. Let me just get my mouse up here. We can continue this sort of downward trend. It's expected for the seasonality. Everybody's kind of going down in that sense, but we are still sitting higher than what we normally do. Looking at sales volume, again, the push that we had for a spring market really was our April and May, but still only hovering around 50 units in Aurora. So that's the people that are just moving because of life. They're not really taking advantage of the market or otherwise. That's just the amount of people that will move kind of regardless of what's going on, because we've stayed fairly consistent from April all the way over to November. Interesting that January and February were so slow in Aurora in particular, compared to previous years. Taking a look at median price, we are getting awfully close to that 2020 pricing. Matt, I venture to say that if things keep going the way they are, December might cross over that line there where we dip just below the 2020. Now, new market, as we had seen there, they were down below it already. They're the first to do so. Aurora's coming pretty close right now.
Yep.
Months of inventory, still up there, not as high as new market right now, but not far off, 5.54 months of inventory currently. And again, you can see this trend line. It does look like we're finding new bands here to play within, so who knows? All signs are still pointing to this potentially going up or at least maintaining those levels. We haven't seen enough new buyers come in to really tip those scales. New listings being down a little bit is helpful. All right, Matt, talk to me about what we're seeing here in Georgina.
Georgina, was I looking at the wrong? I was looking at the wrong charts. Okay. So in Georgina, month over month, we were down 1.2%, year over year, down just under 4%. When it came to transaction volume, we were down 24.1% month over month and 15.4% year over year. So definitely a big downtick for transactions in Georgina. New listings volume down 41.6% month over month and 15% year over year. When we're looking at median days on market, they were up 1.8% month over month and 16% year over year. So definitely a big uptick as compared to last November. And then termination volume was down 34.7% month over month, which was a big one, but up 3.2% year over year. When we're looking at the new listings chart, again, like most other places, kind of right in the mix. We've definitely seen a handful of other years that had more new listings going into the end of the year. So that's not a terrible sign. But again, when we go over to the active listings, again, we're still quite elevated there. But again, we still have, 2024 that was higher, 2017 that was right in the mix. So we have had years before where we've been at these these highs. But when we head over to the sales volume, the interesting thing here is, a lot of the other freehold areas that we've looked at, sales volume is either making an all-time low for November or right down there. But we have seen a worse period, which was in 2023 in Simcoe. And we've talked about this in the past a lot. Like, Simcoe did get pretty hammered right off the bat, as some of those outer regions do. As the markets start to shift, you start to see the outer regions get affected first, and then it kind of circles back into the Toronto area. Because when we go over to the median sale price, something's a lot different here than what we've seen in York Region with Newmarket and Aurora. Their prices are right in the mix there. They're still well above 2020 prices. And I think a lot of this has to do with just the affordability of the price for the area. Did it get as carried away? Well, yeah, it did in 2021, but the rest of the period has been quite tight. So, if you're transacting or you're buying in Georgina, you're in a band of where these houses are selling for these prices, and they've sold there for multiple years. And there's definitely a bottom of where prices are going to be. Are you going to go back to 2020 prices here? It doesn't look like you're going to do it there. It looks like you're going to do it in Newmarket and Aurora, but Georgina's in a nice little price band because you're below the 800,000 mark. You're not at the million.
Yeah, exactly. That's a great point. And it's funny how along the chart you can see a lot of times where these years just kind of stayed together in terms of that pricing. And in comparison to Newmarket and Aurora, sitting well above the 2020 pricing, which has been our key one now, because 2021 by this time had really taken off. And then our previous years, this is the fluctuation that we're seeing, but they're hovering around the same there in Georgina in terms of that median price.
And then when we look at the months of inventory at 5.93 months of inventory, we've kind of somewhat peaked out here. We didn't make a new high like we did at the end of, I believe it was either beginning or end of 2024. We've actually started to come off that. When we were looking at months of inventory in Newmarket and Aurora, we're kind of still going for the end of the year. Whereas Georgina has already seen the downtrend of the months of inventory. So it is definitely starting to look like a little bit better of a market than what we're seeing in Newmarket and in Aurora, because of that effect where it affects the outer regions and starts to work its way in. So Newmarket, Aurora definitely have a little bit more pain to potentially go than Georgina does.
Yeah. All right, Matt, I want to keep you going because I know Simcoe's an area that you watch. And for those of you that are on from our Simcoe Mastermind, thank you for staying on. And I hope that you enjoy what you're seeing here. So by enjoy, I mean, I hope that it's beneficial for you. I hope the information is helpful.
So when looking, and Georgina, Simcoe falls into a lot like Georgina, where Simcoe's really seen a decrease in their prices over the last couple of years. So when it came to median price month over month, it was actually flat, which is a pretty good sign considering the amount of transactions that were there. We had 467 transactions, which was down 24.6% month over month. But the median price, the median price held up quite well, which was a good sign. Still down 4.5% year over year, but month over month, definitely doing a lot better. Transaction volume, though, 22%, down 22% year over year. When we're looking at new listings, down 35.5%, which is not as high as some of the other areas that were in the 40s. New listings volume year over year was down 2%. And then when we're looking at median days on market, it was up 31% month over month. We went from 29 days to 38 days on market. Year over year, that's 22.6% increase. And then termination volume saw a nice little decrease month over month, down almost 26%. But year over year, it's still higher by 31% on the freehold side. And then when we're looking at the condo side, again, you're still going to see some weakness in the condos regardless of where you are. So they were down 4.9% month over month, down 3.8% year over year. Transaction volume down 23.1% month over month. and year over year down 23.1% as well. Looking at new listings were down 28.5% month over month and down 4.9% year over year. Median days on market, we're sitting at 50 days on market to move a condo, which is quite significant, especially if we compare it year over year. Last year we were saying, because you know what, when you get into November, get into December, you expect that things will take a little bit longer. But when you compare it year over year, you're sitting at 39 days. So it's another 11 days to try and move off those condos. And we're getting pretty close to sitting on 2 months to offload the condos. And then when we look at termination volume, down 24.2%, which is kind of what we're seeing market wide, but that's still up 28.4% year over year.
Beautiful. So that is what we have wrapped up for you guys today. What I want to make sure that you take notice of is Matt has got a bunch of new data that he's been pulling to take a look specifically on the rental side of things, talking directly to investors, changes that we're seeing with the landlord tenant board. So please subscribe to stay tuned into that. If you're watching this on Facebook, you can scan this QR code and stay tuned with us on our YouTube channel where we chop these up into individual videos so it's easier to digest, as well as you see the other content that we put out there on a more regular basis. So we hope that you got something out of today. Matt, I think the big takeaway when I look at 2025 is it didn't have the outcome that was originally forecast. Obviously, a lot of changes. The trade war, the government change down there in the US had the biggest impact on what we're now feeling in Canada. But like you talked about in the money markets, we are seeing different things impacting fiscally and policy-wise now what's happening in terms of those markets. And I think that as we take a look at some of the headwinds, we're not out of it yet. 2026 is looking to be just as challenging, if not more so, than what we saw already. And the best thing for you realtors that are watching is how can you help people? How can you show up and help people in their homes? How can you connect them with the right person? These are care call times. These are times where you want to be reaching out to people, your database. Matt easily identified people that are going to need help next year. It's easy to pull searches to figure out how you can get in front of them. If you don't know, please reach out to us. We will gladly help you. But the important thing right now is there are going to be people that need help. And as realtors, you are some of the best people in place to be able to do that for them, to make those connections. So please take note of that. If you didn't see a neighborhood or an area municipality on here that you were hoping to see, please comment or DM us. Let us know that you are looking for something particular, or if you want to see a particular stat. We had Caesar that was asking for a more long-term spread in terms of the median price. Instead of seeing them lined up year over year, he wanted to be able to show guys, look what happens when you buy here to where we are. There's some great charts that we provided in the past that show what this dip really looks like in the grand scheme of things. The people that are being impacted the most in this market are the people that have bought in the last 5 years. Everybody else, it's a completely different conversation to have. Depending on when people refinance, it's a different conversation to have. So please take good use of the data that we are sharing and use it as you are helping your clients and using it to help people that need to make a move. Matt, anything else you want to share before we take off for today?
No, I think the key, you said the key there, and it's yes, is 2026 going to be a challenging market? Absolutely. Are there going to be a lot of people that need our help? 100%. Is the rental market going to be a significant place that realtors should be looking at for business? Absolutely. You've got rental prices falling, a lot of rental units hitting the market. There's a lot of renters that are going to need help next year. And then when it comes to individuals that purchased in 2021, if they went in with a small mortgage, 10 to 20%, they're going to need our help, and they're going to need the professionals that we have at our disposal to help them out as well, to either keep them in their homes, or if they do need to make a transaction, doing it potentially sooner than later. Because if we do start trending next year as we trended this year, it's probably best that you make a move sooner in the year than wait the year out.
Yeah, that's a great point. And I look forward. We are going to be putting out more of those individual videos on our YouTube channel, specifically answering those questions. Should I keep my home on the market? Should I push for a price reduction now? Should I wait for the spring market? Should I wait for those beautiful pictures of the pool when everything's open? We've got the answers to that because the data is showing us what's going to happen, right?
Absolutely.
So
And
it's
we're three
important to note.
people away from 100 subscribers. So if you haven't
Yes.
subscribed, please
Thank you.
subscribe. It's a big milestone we've been waiting for. If you get any
Yes.
value out of this, share it, like it. It'd be a huge help.
Absolutely. All right, everybody. Thank you so much for tuning in. We look forward to seeing you next time. Bye for
Thanks,
now.
guys.